So hello everyone, hello teacher. My name is Quách Thành. I'm from 1TC class, and now I will present about the investment function in financial service management and liquidity reserves management treasury policy. So it including into two main parts: the investment function in banking and financial service management and the liquidity management. And first, I will talk about the investment function in the banking and financial service management. So first part, I'll talk about the function of buying security portfolio. Um, and this function will with the aim of stabilizing the bank income, provide the geographic diversification, backup source of liquidity, reduce tax exposure, and is some type of market instrument used by bank, including money market instrument. We have the treasury bills, short-term treasury notes, certificate deposits, aero currency deposits, commercial paper, and the capital market instrument. We have the municipal bond, municipal notes, corporate notes, long-term treasury note, and bond. Next, I will talk about the factor affecting the choice of security. Firstly, is expected rate of return. We have the formula PV bond equals CP over 1 plus year to maturity, root T plus FV over 1 plus a year to maturity root N, which CP is an annual coupon payment and FV is a face value of security. Next is a tax exposure with a tax stated of state and local government bond. Next is a interest rate risk that rising interest rate lowers the value of previous issue bond. The longest term bond suffers the greatest losses, and nowadays they have several kind of interest risk too, such as future option, swap, and forwards. Next is a liquidity risk that is the breadth and depth of secondary market, the number of trader and the volume of trader. Next is a business risk that risk the economy of the market area they serve may turn down. Next is a core risk that is a corporation and some government reserve the right to enter the security in advance of their maturity. Next is a inflation risk is a purchasing power from the security or loan may be eroded by rising price. In addition, it's about the investment maturity strategy that they have for strategies that including the later or spade maturity policy, the front end and the back end loss maturity policy. And after that, I will present about the liquidity management. And the first part, I will talk about the source of demand and supply of liquidity. So before talking that, first we have to know what is the liquidity. So it is the availability of cash in the amount and at the time needed at a reasonable cost, which have a formula that L equal supply of liquid fund minus demand for liquidity. Next, I have to talk about the supply of liquid fund, including the incoming customer deposits, revenue from the sale of non-deposit service, customer loan repayment, and the demand for liquidity, including customer deposit withdrawal. Next, we also have to know why banks face a liquidity problem. The first reason that bank imbalance between maturity date of their assets and liquidity, and they have a high proportion of liquidity subject to immediate repayment. Maybe they have the sensitivity to change in the interest rate, and have the confidence in the U.S. payment system. Next, I will talk about the liquidity management strategy. So in this part, they also divide into three small main parts: the asset liquidity management, the borrow liquidity, and the balance liquidity strategy. So first, I will talk about the asset liquidity management. The liquid assets are an alternative source of fund, and they have several characteristics, including ready market to be converted into cash, reasonably stable price, deep market, and they also have a reserve reverse, including primary forecast and secondary reverse, treasury bill, municipal bond, in order to protect buying from financial market loss of confidence. Second, I will talk about the borrow liquidity that by purchase or borrow from money market to cover all its liquidity needs. So in this part, I now will talk about the source of borrow fund. We have the federal fund purchase, selling security for repurchase, repos, issuing large CDS greater than $100,000 euro currency borrowing. And after this talk, we also know how to address the liquidity problem by knowing the volatility of interest rate, the how rapidly availability of credit chain, and uncertainty to net income. So after talking these two parts above, now we will talk about the balanced liquidity management strategy that combine use of a liquid assets holding and borrow liquidity to meet the liquidity needs and guideline for liquidity manager that keep track of all fund using and fundraising department. And after that, we will talk about the estimate liquidity need. So in this part, they also divide into 4 small parts: the source and use of fund approach, structure of fund approach, liquidity indicator approach, and signal from the marketplace. The first, I will talk about the source and use of fund approach. In this part, they create a certificated model to project change in loan and deposits, such as projected growth in economy, projected quarterly to corporate earning, current growth rate in the money supply, and change in deposits. That projected growth in personal income, projected increase in retail sale, with the total formula that change in liquidity equal to change in deposits minus the change in loan. Next is a liquidity indicator approach. So it's have many indicator, and I will present one of the most first. First is a cash position indicator that the cash and deposits due from depository institution over total asset, whereas a greater proportion of cash implies the institution is in a stronger position to handle immediate cash needs. The liquid security indicator that U.S. government security over the total asset, which compare the most marketable security and an institution can hold with the overall size of its asset portfolio. The greater proportion of government security, the more liquid the depository institution position tend to be. The capacity ratio is a net loan and lease over the total asset, which is really a negative liquidity indicator because loan and lease are often the most illiquidity of assets. The net federal fund and repurchase agreement position is a federal fund sold and reserve repurchase agreement minus the federal fund purchase and repurchase agreement, and it's over the total asset, which measure the comparative importance of overnight loan relative to overnight borrowing of reserves. Liquidity tend to be increased when this ratio rise. So in this approach, they have also many kind of approach. I don't have much time to talk about loan commitment ratio, deposit composition ratio, core deposit ratio, or hot money ratio or deposit brokerage index. And next I will talk about the signal from the marketplace. So as we have studied, many analysts believe that they want ultimately sound method for assessing a financial institution liquidity need and how well it fulfills them. This method central of the discipline of the financial markets, and no financial service provider can tell for sure if it has a sufficient liquidity until it has passed the market test, including the public confidence that they have a test that is there evidence the institution is losing money because the individual and institution believe that is some danger, it will be unable to pay its obligation, and maybe all the stock price behavior. They also have a question that is a corporation stock price falling because the investor perceive the institution has an actual or pending liquidity crisis. And final part, I will present about the legal reserve and money position management. So first about the legal reserve, and that we know that the manager of the money position is responsible for ensuring that the institution maintain the adequate level of legal reserve, assess the law and central bank regulation. There must be held in support the institution deposits, and the legal reserve requirement is all applied to all qualified depository institutions, including commercial and saving bank, saving loan association, credit union, and agent and branches of foreign banks that offer transaction deposits or non-personal time deposits or borrow from the euro currency liability. Next is about the money position manager that most large depository institutions have designated an official of firm as the money position manager. And smaller bank and trip often has this job to over the larger depository with whom they have a correspondent relationship. And you know that there is the whole deposits to have to clear, check, and meet other liquidity needs. So that is the end of our presentation. Thank you for listening.